Hey there folks, Greg Shepard here, S&A Financial Services. Got another video for all of you out there regarding the complexities that TIAA presents all of you out there. Okay, so today's video is going to be a little different, a little unique in a good way. So let me set the table here. One of you reached out to me, one of you folks out there watching these YouTube videos and presented his situation to me. Okay, in turn, we came up with 3 scenarios. Which one are we going to initiate? I'm going to present those scenarios to you and ask you the question, which one would you do? Okay, and then in a later video, I will tell you what we did initiate, because we haven't really decided, to be honest. I think we narrowed it down to 2. So with that being said, hang tight and I'll go over that situation, because I guarantee this particular situation may not be exactly what you're going through, but I know you can nitpick and take things from these scenarios that can be implemented for your situation. Okay, so hang tight and I'll fumble through that successfully. Again, for those of you that don't know me, my name is Greg Shepard. I do specialize in helping folks all over the country and all over the world just unwind and make TIA not so complex. How about that? Okay, so if you have questions over this situation or your situation, by all means contact me. My information should be below. Okay. Hang with me here as I fumble through this, because I got to remember all this stuff, okay? It's not what it used to be up here. It's still good, mind you. Okay, so again, this individual reached out to me and retiring next year, early next year. We're in October, November for the sake of this video, and going to be retiring in January. So a couple-ish, 3 months, something like that. We being he has 25% of his total portfolio in TIAA Traditional, of which 2 of those contracts are illiquid. One or 2 of them were liquid. So we had a couple illiquid, a couple liquid, okay? Represented 25% total of his portfolio in Traditional. Excuse me. He has a mortgage. So this is where a lot of you out there, these are the questions you're gonna fumble with. He has a mortgage he'd like to pay off, okay? If he doesn't pay it off, he could do it in 6-7 years, something like that, all right? We like to pay it off, even though we realize that the rate on the note, 4%, I believe, okay? So even though we realize maybe the answer to the solution or to the question may not be the most financially sound, it could provide him, we'll call it peace, or however you want to word this, psychological peace at night, knowing that his mortgage is paid off. So if something goes south, he doesn't have to worry about that mortgage payment, okay? So keep that in mind. So scenario, he's married, okay? Wife is younger, 9 years younger, and she is working, I think, part-time still. He will take Social Security, already taken Social Security actually, or he's gonna start it early next year. It's almost irrelevant, and to a degree. Okay, so scenario 1. He actually called TIA before he contacted me, and the TIA rep wanted him to put more into Traditional for purposes of lifetime income, basically more than doubling the amount he has now. Okay, remember, he has like 25% there now. It'd push him up to 40 to 50%, I believe, if I recall correctly, and then initiate lifetime income. And there's a reason behind that, but we won't get into it right now. Then the rest of the money that's liquid over at TIA, we roll it over to Charles Schwab in my case. We invest in income producing things and then siphon from that for income purposes, okay? If we initiated this strategy, he would still have a mortgage payment, and he would still, of course, pay that mortgage for 6 or 7 years, depending upon how much additional payments he put towards that. So there's one scenario. Scenario 2 would be to initiate lifetime income for the monies that he has currently in Traditional. Remember, it represents about 25%. Then roll over the rest of the money, the liquid monies, outside of Traditional to Schwab, very similar to what we did in option 1, scenario 1, and then siphon from that account for income as needed. Now, what I failed to mention to you, that the payout rate for lifetime income for this individual is 7.5%, and then 7 point something, a low 7s for new monies going in. That's important because that affects or impacts option number 1, okay? So again, option number 2, lifetime income for the current monies in Traditional, roll over the other monies liquid to Schwab, IRA, siphon for that IRA, from that IRA for income as needed. Number 3, initiate 10-year TPA on the illiquid traditional, roll everything else out to Charles Schwab, okay? Take out the amount needed to pay for his mortgage, so he no longer has a mortgage, okay? That 10-year TPA is directed to his rollover IRA. If he did this, he wouldn't necessarily need the income from the rollover IRA because he has a pension and Social Security. He lives just lightly. He doesn't spend a lot of money. He wouldn't need the income from the rollover IRA because his mortgage is taken care of and he could live, like I said, on Social Security and his pension. Okay. Now, what he's doing with this scenario is giving up quite a bit of liquidity, okay, and relying more on fixed sources of income, Social Security, and his pension. Now, he would have access to that rollover IRA if he ever needed it, but the amount in a rollover IRA is less than those two options previously discussed. You following me here? Okay. I ask you out there, given these three scenarios, and remember, I can already tell talking to this individual, I think high on his list, just from a psychological perspective, is paying off that mortgage. As I mentioned on the onset of this video, that may not make the most financial sense, but will he and his wife sleep better at night knowing that mortgage is paid off? Probably so. Okay. So to recap real quick, I know I'm trying to go not to go long here. Throw more into lifetime income than what he currently has. Throw more into traditional for purposes of lifetime income, more than he currently has. He currently has 25%. That'd bump it up to 40, 50% of traditional. Kick that into lifetime income. Your payout rate is going to be, let's call it 7.25%. Not great, not bad, okay? Rest of those monies at TIAA, you throw over to Charles Schwab and rollover IRA, invest in income-producing things, siphon for income as needed. Option one. Option two, initiate lifetime income for the amount in traditional that he currently has, which represents about 25% of his total portfolio. Payout rate is going to be 7.5% because there's no new money going in, okay? And then the rest of the money, liquid, go to Schwab, same as option number one, siphon from Schwab, from rollover IRA for income as needed. Option number three, that was option number two. Option number three is a little different. You initiate 10-year TPA from the illiquid traditional amounts, okay? Those TPA payments annually are going to your rollover IRA. You extract from the liquid money would go over to the rollover IRA. From that rollover IRA, you take as income, if I didn't mention that previously, this would be ordinary income, okay? From that rollover IRA for purposes of paying off that mortgage. Remember, we've got a 4% note on that mortgage. It's pretty good. Pay off that mortgage. That lessens the liquidity in the amount in the rollover IRA, but he doesn't need to take it out for income, okay? Because he can live on Social Security and a pension that he has, all right? So three options that were presented to me that we kind of played around with. Which one would you initiate? Okay, I think I have an idea of one we're not going to do. Okay, I'm certain we're the one we're not going to do. And then it comes down to two options. I don't know if there's really a bad answer. Financially, it probably is not a bad answer. There's probably a more efficient answer financially. But again, high on his list is paying off that mortgage, okay? But it only take him 6 or 7 years to pay it off. So that's not the end of the world either. What say you out there, okay? Draw me a note, I guess, in the comments or shoot me an email. I'm just curious as to what your thoughts are. Maybe I left out a variable or two that I haven't, thought of. I tried to remember all the scenarios. So, and I guarantee a lot of you out there are asking the same question about that mortgage payment versus, lifetime income or other options afforded to you from your TIAA stuff. All right, it's enough for today. I'll have a follow-up video letting you know what we ultimately decided, right or wrong, okay? Greg Shepard here, S&A Financial Services. Hey, go on and have a good one. Y'all take care. Bye-bye.